CNBC TV 18 Investor Camp.
Hello and welcome to yet another episode of the CNBC TV 18 Investor Camp. This week, or rather this month, our Investor Camp team has traveled to the city of Pune. It's not too far from where our head office is, but the investors in Pune are as savvy or as informed as the investors in the city of Mumbai. Now, it has been a very volatile phase for our markets, as we all know. We've corrected 10% from the top, since we hit that 30,000 mark earlier this year. Is the bull market fever receding, or is it just a shorter-term correction in an otherwise longer bull market? Well, the feedback, or rather the tone from experts, is that this is merely a correction in an otherwise longer structural bull market that India is in. The problem is we don't have too many positive cues to work with. So on one hand, earnings have been quite weak. On the other hand, global markets are starting to lose a bit of sheen. And of course, then we have the reform momentum as well. Investors are now losing patience on the Modi government. At least the reform momentum has been slowing down compared to what was expected earlier. But our experts here will tell us what we should be doing in this market. Is this still a great opportunity for long-term retail investors to buy in? So without wasting any time, let me introduce our first guest on the panel, Rajesh Kothari, the Managing Director of AlfAccurate Advisors, to give us some fundamental views on the market. Please put your hands together for him.
Thank you, CNBC, for giving us a wonderful opportunity to present our views on the structural bull market, which we see over the next 3 to 5 years. We believe that current correction provides a very good opportunity for the investors to increase their equity allocation, because over the last 5 to 6 years, probably from 2009 to 2014, the investors have increased their exposure on fixed income and or on the real estate side of the asset. The equity weight on the overall asset allocation for Indian households have reduced probably to last 6 to 7 years low. So we believe the correction provides a wonderful opportunity. We were hearing in last 9 months, whenever I used to meet investors, both retail as well as family offices, they were always asking me, correction kabhi aayega? Because we want to buy as a decline. And when correction comes, of course, they say, abhi yahan se upar jayega ki abhi aur niche dikhta hai. So that's the typical mentality of any investors. And of course, you would like to time each and every, buying at right time and selling at right time. But generally, that's a wishful thinking. What we should always look at is the long-term opportunity. So we believe that, Sensex, our target is around close to 50,000 Sensex by March 2018, which is 3 years from now on. And I will just show you a few slides on why our view is that over 3 years, we see almost kind of a 70 to 80% high levels from current Sensex levels. To make things simple, we divided the phases into 3 phases. The first one is green signal, which is a golden period of growth, which is FY03 to FY08. Second was a period of halt, which was a red signal, which is FY08 to FY14. And now we are almost at yellow signal, which is moving towards green, which is recovery to growth, FY14 to FY20. The important point, I will not take you to the details, given the limited time, but the important point to note is that if you look at FY03 to 08, the GDP growth was 4% in FY03, from which it went up to 9.3%. And in FY08-14, it came back from 9.3 to almost close to 4%. And from 4%, now we expect again to go back to probably closer to double digit, 7.5, 8, and then probably 9, 9.5 over the next 4 to 5 years. And as the GDP grows, the IIP is also a reflection of the GDP, because the bulk of the GDP growth is going to be contributed by the index of industrial production. And most important is my third line, that Sensex earnings grew at 25% in the first golden period of growth. And that 25% reduced to as low as 0% in FY04, and which we now expect from the current year onwards. We believe there is going to be healthy double-digit growth over the next 3 to 5 years. That entire journey from FY03 to FY14, that is close to 11, 12 years, is a mirror of what has already happened during that time, and same thing is probably going to repeat over the next 3 to 5 years. And when the same things are going to repeat, the Sensex earnings growth, which was mirroring the GDP growth, but it grew at a very, very double digit of 25%. And the price to earning multiple, that expanded significantly, which was, very low, just close to double digit 11 times in FY03 to as high as 25 times in 2008. So what it says? It says that when the earnings growth becomes very high, the price to earning multiple also get expanded from low double digit to high double digit. If I just put two slides and one dissects the economic recovery in FY03 to FY08, Sensex net profit compounded growth was 25% and Sensex delivered 38% growth. So Sensex growth, that is the actual market cap growth, was higher than the net profit growth. If you further dissect this, Sensex went up by 5 times. I repeat, Sensex went up by 5 times during this FY03 to FY08 period. And most BSE indices, sectoral indices, I'm not talking about the stocks, I'm talking about the indices in general, they delivered minimum 5.3, like cycle indices, to maximum 15 times. So capital goods indices, for example, it grew by 15 times. So there were correction even during those times, but point-to-point return was 5 times for Sensex, and for many cyclical indices, minimum of 5 times and maximum was 15 times. Why we think that this is going to be the same period what we have seen in FY03 to 08? Why we believe that it is going to repeat? We believe it is going to repeat because the GDP growth, average GDP, if you see that blue line, was 6.9%, and we are already moving to better GDP in FY15, and IIP is also moving towards the better growth in FY15. Fiscal deficit definitely is much under control, and current account deficit has improved significantly in last 5 to 7 months. Two most important pillars for any equity market growth is number 1, inflation, and number 2, interest rates. The inflation, we are not saying that it has already become, WPI was a decade low, and CPI has also reduced significantly. March 15, the latest CPI print was 5.2%. So this has already happened. So I'm not talking about all futuristic that this will happen and that will happen. I'm saying it has already happened. And because of that, the interest rates are also coming down, although gradually, but the trend is very clear. It is not moving up, the direction is moving down. And if these two factors are favoring our economy, then definitely there will be multifold effect on all the other parameters. So there are few early signals of economic recovery. While many of you probably might be of the opinion that nothing is happening on ground, there is no recovery as such, we believe that early signs of recovery are already in place. If you look at the IIP, which is the biggest single most important barometer for any economic recovery, is already showing signs of improvement. Within that, the capital goods production is showing further signs of improvement. If you look at the MHCV volume, medium and heavy commercial vehicle volume growth is very healthy for third quarter as well as for the fourth quarter. If you look at the cement volume, was again very healthy, closer to, from negative growth, slowly started coming back and is now running, and probably as we move into second half, will go into double digits. NHAI project award for FY15 was significantly higher, almost 2 times compared to FY14. And considering the budget allocation, we think it is going to increase significantly over next 2 years. And because of all these factors, the earnings growth cycle is going to revive. And therefore, if you look at 93 to 96, there is a 45% earnings compounded growth. In 96 to 03, that became flat, it's just 0%. And then again from 0%, it became a healthy double digit of 25%. From 25%, it reduced to 9%. And we believe that next 3 years, we are going to see at least 17 to 20% earnings growth over next 3 years. Now, this is very, very simple slide to make life easy for all of us, that you assume earnings growth and you assume price to earning multiple and what are the various outcomes over next 3 to 5 years. If you assume 18 times price to earning multiple and if you assume 18% earnings compounded growth, then Sensex target comes to 49,000. Now, if you want to be conservative and you want to assume that I would like to assume 15% earnings growth and 15 times price to earning multiple, then it gives target of 36,000. And if you want to be bullish, that we believe that 20% earnings growth and 20 price to earning multiple, then it comes to 58,000. So there are all probable scenarios which are already well drafted in this slide. Realistically, I think as GDP improves, inflation is already in control, interest rates are coming down. There is no point in assuming conservative lower earnings growth because there is a down effect on the corporate's earnings. It is a question of time. Maybe 1 quarter late, maybe 2 quarters late. But anyway, we are not projecting quarterly numbers. We are projecting 3 years equity as an asset class. Therefore, I think it is safe to assume 17 to 18% earnings growth because anyway, our base is very, very low. So from low base, it is not very difficult to deliver 18% earnings growth. And if you assume that, then that becomes 20% compounded returns from the equity as an asset class, assuming close to 27,900 Sensex. If you are bullish, then these returns can be as high as 28 to 35% compounded, much significantly higher than what other asset classes offers you.
CNBC TV 18 Investor Camp.